Okay, so you want to buy a casino. You're picturing the Bellagio fountains, high rollers dropping $50,000 a hand, free champagne floating around on silver trays, a private jet parked out back waiting to take you to Monaco next weekend. You picture a business where the house always wins, so all you have to do is sit back in a leather chair and watch the money roll in forever, year after year. Like a slot machine that never runs out of coins. That's the dream. Here's what actually happens. First, let's talk about how you even get into this business, because it is nowhere near as simple as buying a hotel or opening a restaurant. You can't just find a casino listed for sale, wire the money, and open the doors next week. In almost every jurisdiction on Earth, gambling isn't treated like a normal business. It's treated like a public utility crossed with a loaded gun, something governments guard jealously because of how much tax revenue and social risk it carries. You need a license, and getting one can take years and cost you millions of dollars before you've even touched a card table or hired a single dealer. Regulators will investigate your personal finances, your business partners, your criminal history going back decades, and even the criminal history of anyone who's ever lent you money. This process alone can take 2 to 3 years before you're even allowed to break ground. Look at Macau. When the government retendered its 6 gaming concessions back in 2022, the winning operators had to commit to spending a combined 15 billion US dollars over the following decade just to keep the right to operate. $15 billion in commitments before a single new guest checks in. That's not an investment, that's a toll you pay just to stand at the starting line. In the United States, the numbers are smaller, but still brutal. A commercial casino license in a state like New York can run anywhere from $500 million to $1 billion just for the bidding rights, separate entirely from the cost of actually building the resort. And then there's Las Vegas, where land alone on the Strip can cost tens of millions of dollars per acre. A full-scale resort casino, the kind with a hotel tower, a convention center, multiple restaurants, and a sprawling gaming floor, can run you anywhere from $1 billion to over $4 billion. The Cosmopolitan cost roughly $4 billion to build. Resorts World Las Vegas cost about $4.3 billion. These are not typos. This is simply the entry price of admission to a business you haven't even opened yet. So let's say you clear that first hurdle. You've secured your license after years of paperwork, hearings, and background checks. You've bought your land. You've hired an architect and a design team. Now here's where the first hidden trap kicks in, and it is a big one: the enormous gap between when you start spending money and when you start earning any back. Construction on a major casino resort takes 3 to 5 years, sometimes longer if there are permitting delays, supply chain issues, or labor shortages. During that entire time, you're paying interest on the loans you took out to build it, and casino construction loans are not small, often carrying interest rates well above ordinary commercial real estate because lenders know how volatile this industry can be. You're paying architects, engineers, contractors, and union labor by the thousands. You're paying for gaming equipment, and slot machines are not cheap either. A single high-end slot machine can cost $15,000 to $25,000, and a big casino floor might have 2,000 of these machines sitting on it. Do the math on that. That's tens of millions of dollars in machines alone, sitting there depreciating in value before a single coin ever drops in. Add table games, chip inventory, security systems, and surveillance networks with thousands of cameras feeding a control room around the clock. And the equipment bill alone can rival the cost of a mid-sized hospital. And once you finally open the doors, you don't just flip a switch and start printing money. You have to hire and train thousands of staff: dealers, pit bosses, surveillance operators, hotel housekeeping, valet, security, and accountants who track every single dollar because gaming regulators require exhaustive record keeping down to the penny. On every table, major Vegas resorts often employ anywhere from 5,000 to 12,000 people. You have to market your grand opening, which usually means comping rooms for free, giving away free play credits, hosting concerts and boxing matches just to get bodies through the door and talking about you. Resorts World Las Vegas actually posted losses in its first full years of operation, in part because the ramp-up costs of running a massive integrated resort take real time to work through, even once the building is technically open for business. You're bleeding cash for months, sometimes years, before the machine finally starts running at capacity. Meanwhile, that construction debt has interest payments due every single month. Whether you have a single guest in the building or not, The bank does not care if your grand opening got rained out. Now, let's get into how a casino actually makes money once it's up and running, because this is where it gets interesting. And it is not just people losing at blackjack like you'd assume. The first and most obvious revenue stream is the gaming floor itself, and specifically it's built on a mathematical concept called the house edge. Every single game on that floor is mathematically designed so that over enough hands, enough spins, enough rolls of the dice, the casino keeps a small percentage of every dollar wagered. It's not luck. It's arithmetic repeated millions of times a day across thousands of machines and dozens of tables, all running the same math in the casino's favor. On slot machines, that edge is enormous for the house, often keeping 4 to 15% of everything played through the machine, which is exactly why slots typically generate 40 to 70% of a casino's total gaming revenue. They are quite literally the most efficient money printing devices on the floor, requiring no dealer, no rest breaks, and no mistakes. Table games have a smaller house edge, roughly 1 to 5% depending on the game, but high rollers wager so much money per hand that even a razor-thin edge adds up to enormous sums over a single night. Here's the catch, though. This obvious revenue stream, the one everyone pictures when they think of a casino, is also the one that government watches closest and taxes the hardest. In Nevada, casinos pay a gaming tax of up to 6.75% of revenue. That sounds manageable. But in Pennsylvania, the tax on slot revenue is a jaw-dropping 54%. 54 cents of every dollar that machine wins goes straight to the state before you've paid a single employee or a single electricity bill. So, the flashiest part of the business, the slot floor, everyone associates with casinos, is often the part where the operator keeps the smallest slice of the pie, while the state quietly becomes the real business partner in every single spin. The second, less obvious revenue stream is everything that isn't gambling at all. And in modern casino resorts, this has become just as important, sometimes more important than the tables ever were. Hotel rooms, restaurants, nightclubs, spas, high-end retail shopping, concerts and long-term residencies, massive convention and trade show business. In Las Vegas specifically, non-gaming revenue overtook gaming revenue years ago. The entire Las Vegas Strip now generates more money from rooms, food, shows, and shopping than it does from the casino floor itself. Think about how strange that is. The city built its entire identity on gambling, and gambling is no longer even the majority of the money. This side of the business is less regulated than gambling, and often carries far fatter margins, especially nightclubs and bottle service, where a bottle of vodka that costs the venue $20 to buy wholesale can sell for $800 at a VIP table with sparklers stuck in the top. A residency deal with a major pop star can fill a 5,000-seat theater every single night for months at a time, with tickets going for hundreds of dollars each and merchandise sold on the way out. Convention business is quieter but just as lucrative, filling hotel rooms midweek when leisure travelers wouldn't otherwise show up, smoothing out the revenue curve across the entire month instead of just weekends. This is the part of the business that lets smart operators diversify away from the volatility and heavy taxation of pure gambling, and it's also the part that keeps the lights on during slow gambling years. There's actually a third income stream too, and it's the one most people never think about at all, the whale. High net worth gamblers, sometimes literally called whales inside the industry, fly in on private jets and can lose or win tens of millions of dollars in a single visit. Casinos extend enormous lines of credit to these players, sometimes tens of millions of dollars at a time, essentially becoming private, unlicensed lenders to some of the wealthiest gamblers on the planet. This can be wildly profitable when it works in the casino's favor, because whales tend to lose more than they win over time. That's just math again. But it's also a massive concentrated risk, because when a whale gets hot and wins big, or worse, defaults on their markers, meaning the IOUs casinos issue for credit play, it can blow a hole straight through an entire quarter's earnings. Some casinos have reported single-digit million-dollar swings in profit tied to the fortunes of just one or two high rollers in a given quarter. That's an extraordinary amount of risk concentrated in a handful of individual relationships. And it's part of why junket operators in Macau, the middlemen who bring high rollers in from mainland China, became such a powerful and controversial force in that market for years. So now let's talk about how this business actually fails, because it absolutely does fail, and it fails spectacularly, and often the clearest cautionary tale in modern casino history is Atlantic City. Through the 2000s, Atlantic City had 12 operating casinos lining its boardwalk. By 2014, 4 of them had closed in a single calendar year: the Atlantic Club, Showboat, Revel, and Trump Plaza. Thousands of jobs vanished almost overnight in a town that had built its entire economy around gambling tourism, and the boardwalk that once symbolized American gambling glamour started to look like a ghost town in places. Revel is maybe the most painful individual example in the entire industry, a genuine textbook case of how badly this can go. It cost $2.4 billion to build an absolutely enormous sum for a single property. It opened in 2012 with huge fanfare, and it filed for bankruptcy within about a year. It limped along for a bit longer before closing permanently in 2014. Then it sold at auction for just $82 million. Read that again. $82 million against a $2.4 billion construction cost. That's roughly 3 cents on every dollar it cost to build. Why did it collapse so completely? A combination of oversaturation, since Pennsylvania and other neighboring states had legalized their own casinos and stopped people from having to drive all the way to Atlantic City at all anymore, plus a brutal recession hitting right as it launched, plus the building itself being enormous and expensive to run with a customer base that simply wasn't there in the numbers needed to support it. Then there's Donald Trump's casino empire in Atlantic City more broadly, which tells a similar story from a different angle. Trump, Taj Mahal, once the largest casino in the world when it opened in 1990, cost over $1 billion to build and was so loaded with high-interest debt that it filed for bankruptcy within about a year of opening its doors. Trump's various casino companies collectively filed for bankruptcy multiple times through the 1990s and 2000s, restructuring debt over and over while still trying to operate. The lesson from both of these collapses is the same, and it echoes through this entire industry. Casinos are extremely sensitive to debt load, to regional oversaturation from new competitors, and to macroeconomic downturns. Because gambling and travel are both things ordinary people cut from their budgets first, when money gets tight at home. Now for the flip side, because when this business works, it really spectacularly works, and it's worth understanding exactly why take Sands China, the Macau-focused subsidiary of Las Vegas Sands. Before the pandemic, Macau alone was generating gambling revenue several times larger than the entire Las Vegas Strip combined. Because unlike Nevada, Macau's economy is a monopoly-style regulated gambling market that draws in high rollers from mainland China, where casino gambling is otherwise illegal. In peak years, Macau's gaming revenue topped $36 billion annually, dwarfing anything Vegas could produce. Or look at Marina Bay Sands in Singapore, a single integrated resort that reportedly recouped its multi-billion-dollar construction cost through phenomenal margins on both gaming and non-gaming revenue, driven by a location with essentially zero domestic gambling competition and a captive, wealthy Southeast Asian customer base with nowhere else legal to go. That single property has, in some years, generated a meaningful share of its parent company's entire global profit from one building on reclaimed land in one city-state. These successes share a clear pattern, and it repeats itself across the winners in this industry: geographic monopoly or near monopoly status, a wealthy nearby customer base with limited legal alternatives, and disciplined management of construction and operating debt. Every single one of those pieces matters, and losing even one of them can be enough to sink a property that looked perfect on paper. So what actually separates the winners from the Revels and Taj Mahals of the world? A few things keep showing up again and again when you study the industry closely. Location and exclusivity matter enormously. A casino with a government-granted monopoly or with genuinely limited local competition like in Macau or Singapore can charge premium prices for rooms and tables and doesn't have to fight a race-to-the-bottom price war with a property down the street. A casino built in an oversaturated regional market, competing with a dozen other properties within a 2-hour drive, is fighting for scraps in a shrinking pie, no matter how nice the chandeliers are or how good the marketing team is. Debt structure matters just as much, maybe even more. Revel and Trump's properties were both loaded with enormous debt relative to their actual revenue-generating capacity. When revenue dipped even slightly below projections, they simply couldn't service the interest payments anymore, and the whole financial structure collapsed like a house of cards. Successful operators like Las Vegas Sands and Wynn Resorts have historically kept a tighter handle on leverage relative to their cash flow. which gives them breathing room to survive downturns that would sink a more aggressively financed competitor. This discipline is boring. It doesn't make headlines, but it's the actual difference between a company that survives a recession and one that doesn't. Diversification of revenue matters too, and it's becoming more important every year. Properties that lean too heavily on gambling alone are more exposed to sudden regulatory tax hikes and to competition from online betting and other nearby states legalizing their own casinos. Properties that built out massive non-gaming ecosystems, hotels, entertainment, dining, retail, conventions, simply have more ways to make money and more resilience when gambling revenue softens in a given quarter, or when a new competitor opens 20 minutes down the highway. And now let's talk about where this entire industry is actually heading, because the ground is shifting under everyone's feet, even the biggest players. Online gambling and sports betting are eating into the traditional brick-and-mortar model everywhere they get legalized. In the United States, since the Supreme Court struck down the federal ban on sports betting in 2018, more than 30 states have legalized some form of it, and a huge amount of that betting now happens on a phone screen, not on a casino floor with a dealer in a vest. This means physical casinos increasingly have to justify their existence, not through gambling alone, but by becoming full entertainment destinations. Why fly all the way to Vegas at all if you can place a bet from your couch in your pajamas? The properties responding well to this shift are the ones building concert residencies, Formula One tie-ins, and massive sportsbook lounges that double as entertainment venues in their own right, complete with giant screens, food halls, and their own ticketed events. Vegas has leaned hard into this strategy, hosting the Super Bowl and a Formula One Grand Prix in recent years, specifically to keep pulling visitors in for reasons that have nothing to do with a blackjack table. Asia remains the other major storyline shaping the next decade. Macau's recovery since the pandemic has been a slow, steady climb back toward its old highs, and Japan has been moving, slowly and very carefully, toward legalizing its first integrated casino resorts. With a major project planned for Osaka, any brand new legal gambling market that opens up anywhere in the world represents a genuinely enormous prize for whoever gets there first, because these markets tend to be effectively frozen in place for decades once the first licenses are granted. That means early movers can lock in a dominant position for an entire generation, while everyone who arrives late is left fighting over whatever market share is still on the table. So here's the honest bottom line on owning a casino after all of that. In the optimistic scenario, you get a license or you buy into an already licensed operator in a market with limited competition. You manage your construction and operating debt conservatively instead of maxing it out. You build out a strong mix of gaming and non-gaming revenue so you're not dependent on the tables alone. And you end up owning one of the highest margin, most cash-generative businesses that exists anywhere in the world. Properties like Marina Bay Sands or Macau's biggest resorts can throw off hundreds of millions, even billions of dollars in free cash flow every single year, essentially acting like a toll booth on human psychology and disposable income, collecting a little bit from an enormous number of people every single day, forever. In the realistic scenario, you sink $1 to $4 billion into construction and licensing before you've earned a single dollar back. You take on years of expensive debt before revenue even starts flowing in. You compete against a market that turns out to be more saturated than your initial projections assume, and you either limp along servicing that debt for a decade while praying for a strong tourism cycle to bail you out, or you end up like Revel, closing within 18 months of opening and selling for pennies on every dollar you spent, becoming a cautionary tale in somebody else's video years later. Because here's the thing, nobody tells you when you're sitting there dreaming about owning a casino, you're not buying a business where the house always wins. You're buying a real estate and entertainment empire with an extremely expensive gambling license bolted onto the side of it. One where the actual house edge belongs to the government that taxes you at rates up to 54%, the bank that financed your billion-dollar construction loan, and the market conditions you can never fully control, no matter how good your marketing team is. You're not buying the house, you're buying the bet that the house stays open long enough and profitable enough to pay off everyone standing in line ahead of you before it's finally your turn to collect.